What do I mean by fundamentals? Because people will just say fundamental and not explain it. Hi everyone, welcome to today's video. So whenever you open your portfolio these days, you are seeing a lot of red and many people panic. Now on this video, I'm going to cover very systematically as to when you should get scared with seeing your portfolio in red vis-a-vis when you should not be getting scared while seeing your portfolio in red. That is the simple discussion that we are going to do. It is an extremely important discussion if you're feeling a little bit jittery in the stock market, if your spouse, if your parents, if everyone around you is saying that, you know what, you don't know anything about stock market, your portfolio is in red, just get out. Okay, this video becomes extremely important from that particular perspective. I will share a lot of examples and data that will hopefully make you a lot more confident about the stock market. Humble request, please like the video. It helps with the YouTube algorithm. Okay, pause the video and like it. Thank you so much. And please pick the frameworks that I'm teaching you and apply it as per your portfolio. Don't go by which specific stock am I talking about. This is a learning channel. I'm teaching you something which is very useful and which will make you more confident. Also, a very quick shout out to our sponsors for today, which is Ditto. It is completely fine to see your portfolio in red for a little while, because if you have purchased good things, it will come back up. That's not a problem. But if you experiment with your health, that is something that you can't afford to see going down. So it is very important to purchase health and life insurance. And the amazing part about Ditto is that you can speak with insurance experts for free, absolutely for free. Not a penny charged. You can understand your insurance requirement, and then if you consider it to be sensible, you can purchase health and life insurance. The link is in the description box. You can use that link to schedule that free phone call. So let us first and foremost understand the concept of stock market losses. And there are typically two types of loss that occur in the stock market. The first is called as a notional loss. So notional loss, let me explain it by using a simple example. So let's assume that you purchased Hindustan Unilever at 2300 rupees. Now it might be trading at 2000 rupees. So your notional loss is 300 rupees as of now. Why is it notional? Because you have not decided to sell it yet. So you're seeing that stock in red in your portfolio right now, which says the loss that you are facing right now is 300 rupees, but that's a notional loss. When would it become a real loss? When you decide to sell off your position, when you decide to sell off HUL on a loss, that is when your loss will become real, and that is called as real loss. So the important point to note is that you must not worry too much about the notional loss. The stock market or stock prices keeps on going up, down, up, down, up, down. So you should not worry too much about that. What you should, however, be worried about is that are you making real profits or real losses? That is the simple point that you need to keep in mind. So of course, your question would be that, you know what, when is it that we should be selling and converting our notional loss into real loss? And vis-a-vis when we should not be selling stuff. That is where the real understanding of the stock market comes into the picture, and we will discuss this. But before getting into that section, let me quickly cover a very important concept around how big investors think about stock market investing by showing you some data. So here is the data of Mr. Warren Buffett's portfolio, which outlines how many times he has taken loss on his portfolio, not one specific stock, on the entire portfolio when he was sitting on his highest ever losses. So you will see that if you track Mr. Warren Buffett's portfolio for the last 40-45 years, you will see that in 1981, 1982, he took a loss of 19% on his portfolio. Then in 1987, 37% loss on his portfolio. In 1990, roughly 37% loss again. In 1998, 49% loss. In 2008 crisis, it was 51%. After that, I have not been able to find the data, but the bottom line that I'm trying to outline here is fairly simple, that even big investors like Mr. Warren Buffett, their entire portfolio also goes in red by a lot. But big investors understand three key things, and these are three same key things that we absolutely need to understand. So what are those three key things? Number one, the stock market goes up in the long run. So here is the chart for Nifty, and if you pick any random date and stretch it out for the next 5 years, what do you see? You would see that Nifty has given a run up in a 5-year window, very easily speaking. Now, why is that happen? So I can get into extensive details and spend 30 minutes talking about it, but you need to understand how stock markets are designed. For example, let me pick a parallel example. When you go on a casino, you know for sure, even when you have not done any mathematical study on it, that casino, who wins? The house wins. The person running the casino wins. Casino always wins systematically, because if the casino is not winning, then the casino will not operate in the first place. It will just shut down shop and go away. That is the same principle. The system in the stock market is designed in such a way that it is designed to go up. If the stock market is not going up, and if you and I do not see any promise of making the money in it, then we would rather invest our money in real estate or gold or cryptocurrencies or whichever assets. So you need to work with the assumption that the stock markets are going to go up. Yes, in the short term it can come down, but the long term it is designed in such a way that the stock markets have to go up. So this is the first key message that big investors understand. The second key message that big investors understand is that there will be a lot of volatility associated with equity or stock investing. Now here is the chart for Nifty, which outlines how many times Nifty has fallen by more than 10%. It has fallen 12 times. More than 20%, it has fallen 9 times. More than 30%, it has fallen 6 times. More than 40%, 4 times. More than 50%, 2 times. More than 60%, 1 time. The point is that these are all volatile phases. If you see the current Russia-Ukraine crisis blowing up and the stock market fall by 40%, 50%, again, my tune will not change. It will stay exactly the same because I as an investor understand that the stock market will go through that volatility. Important point to note is that whenever the volatility is high, whenever this correction happens by 40%, 50%, usually now the recovery is also very fast. This is one of the key points that I had covered on my earlier videos. So this is the second key thing that you absolutely need to understand. The third important point that big investors understand is that investors make money, not traders. Let me do a thought exercise with you. Just comment below in the description box about 5 famous people that you know from the stock market. Almost all of you will start quoting investors, not traders in it. Even when you quote people who do both investing and trading, like Mr. Rakesh Jhunjhunwala, what has been his prime bet? It was Titan. That is what Mr. Rakesh Jhunjhunwala is known for. And has he invested or traded Titan? He's still holding Titan. He has not sold Titan. That has been his biggest money-making asset. And usually on all the assets or stocks on which he has made money, he has invested in them, not traded on them. So if you're investing in the stock market, then please don't start panicking. You need to have a little bit of vision. Now, I've been getting a lot of messages that, Akshat, you know what? Your bet about HUL is completely wrong. The stock will just disappear. Same goes for HDFC AMC. It will completely disappear. Same goes for HDFC Life. It will completely disappear. And HDFC Bank, what can I say about HDFC Bank? It will be eaten up by all the other banks. Okay, so if you really think that 1,000 crore companies which are net positive in terms of revenues, profits, good management, good growth history are just going to become dust, then I can only say that you're looking to trade in the stock market. You're not even looking to invest in the stock market. So please understand this critical difference between trading and investing, that a trader has a very short-term viewpoint on a stock. They can't afford to hold their position and they convert their notional loss into real loss. Why is that? Because they are not trying to invest in a business. They are not even bothered about the fundamentals of any stock. What they are only focused on is the price movement. If it is going up or going down, how they can trade volatility and certain market dynamics. If that is what you are trying to do, then you don't even need to invest in something like HUL and bunch of other good stocks. You can probably trade in some random stocks. You should only be investing in good companies like HUL, HDFC, AMC, etc. If you are an investor, investors are cherishing opportunities what are existing right now in terms of stock picking, because great stocks are available at a discount. So I hope these 3 key points are very clear, because this is the same psychology with which top investors operate. Now comes the most important section, that if you're holding a stock on a loss, on a notional loss, then when you should not get scared. So there are 3 reasons not to get scared. If you see one of these 3 things happening, then hold the notional losses, no problem. First key thing is that if the fundamentals of the stocks have not changed. What do I mean by fundamentals? Because people will just say fundamental and not explain it. So good fundamental simply means that the stock has shown run up in terms of its revenues, profits. There is some kind of moat or competitive advantage that the business enjoys. It has clean management. It has done well in the past. There is consistent history of growth. All good things are happening. It means that the fundamentals have not become worse. A classic case in point here will be Asian Paints. Now you tell me whether the management of Asian Paints is clean or not. Comment below and tell me. Right? That's one. Second, take a look at sales. Has the sales been going up generally speaking over the last decade or so? Yes. Has the profits been going up over the last decade or so? Yes. You will say that no, the trailing 12-month profit has been a little bit low. Okay, only a little bit. It's not as if that the fundamentals have completely evaporated. So there is no massive dip in performance and it's a great stock to own. It has shown consistent history of growth and it will continue to do the same for a substantial future, the way we see it as of now. Now comes the second point, that there is some temporary issue with the firm. So here a classic classic example will be something like HDFC AMC. Now, unfortunately, this is not a company specific issue, but more about the industry specific issue. For example, if you check some of my previous videos, I've covered the points that AMC companies, number one, the competition has gone up. That's a short-term pain. Number two, the market sentiment itself has changed. A lot of people panic, withdraw their money from AMC, stop doing their SIP. So the entire fodder that HDFC, AMC or NAM India, they have under their hold, that itself shrinks. And as a result, these starts company making losses. Third and finally, the interest rate environment changed because the interest rates were lower. The debt mutual funds were not giving returns. People stopped doing their SIP. So this is an industry-wide issue that is plaguing something like HDFC, AMC. This is not a sustainable firm-related problem per se. Now, the simple question that you need to ask yourself is that, hey, are these issues forever going to stay? That interest rates are forever going to stay low? People are forever going to stay away from the market and bunch of different things. So no, this is unlikely to happen for a sustainable period of time. And at some point, these stocks are going to make a good recovery. This brings us to point number 3, that there are macroeconomic issues at play. For example, oil prices have been going up and India has like very high requirements for energy. Therefore, India will stop growing altogether. Therefore, withdraw money from the Indian market and put it in some other market under your pillow also, whatever, right? So the point here is that whenever you hear these type of macroeconomic issues, there is no end to analyzing it from a macro perspective. Now, ask yourself a simple question that imagine a situation where the oil prices are forever high. Now, what is the solution that the world will figure out? Do you think that companies like Asian Paints or Pidilite are forever going to suffer? The answer is no. They are not going to suffer. Why? Because they will figure out some other alternate form of manufacturing. They might realign their supply chain. They might explore more cost-cutting method. They might undertake 100 steps to rationalize their supply chain and bring down the prices. Whenever they do that, their profits will come back and they will start making more money. Now you'll say, Akshat, how do you know this? Because this is not the first time oil prices are going up. Oil prices in the past have gone up quite a lot. Now, can I guarantee that something like Asian Paints will recover? I cannot guarantee, but there is a very, very high likelihood that something like Asian Paints will recover. You should not get stressed out. In fact, an investor like me is investing more money in something like Asian Paints. Now, again, this is not a buying and selling recommendation. Please do it at your own behest. The word of the day today is behest. Let me know what does that mean. But I just wanted to present an analysis that all these macroeconomic issues, they get sorted with time and good companies are able to deal with them. So this brings us to the opposite end of the debate, which says that, hey, when is it that you should be converting your notional losses into real losses? There are 3 reasons why you should be converting your notional losses into real losses. 3 reasons are that if the stock is really, really bad, I will give you an example also. Second reason is if the firm has very high debt and you don't see that debt coming down and you don't have faith on that stock. This is not a necessary condition, but this is one of the key things that you must keep a lookout for. Third and finally, if some kind of pump and dump is happening. So let us discuss each of these 3 points. So what is meant by a bad stock? A bad stock simply means, at least in my definition, a company that is not profit making and has no major prospects of making profits in the future. A classic example here would be Paytm. I don't know, maybe in the future they might make a lot of money, and that is the reason why I was one of the only few people yelling on YouTube not to invest in Paytm IPO. Why? Because it has been cut down by half now, and even now you as an investor have zero clarity whether Paytm will be making money or not. A month back they announced their results and the profits have further gone down. So should you be investing in such companies? I don't know. Can you make money by investing in such companies? Maybe, because we can't predict stock prices in the short term. It can give a massive run up. But you should never invest too much money in such companies unless you are very, very clear that there is a model that is at play that would allow them to make money going forward in the future in a sustainable manner. Even the business model is not clear, please don't go and invest in such companies. Here is an entire video I have done on it. Second key point, please avoid high debt companies. Now you'll say, Akshat, you have recommended in the past 2 high debt companies. One was JP Power and one was India Bulls Housing Finance. So what do you have to say on that? Okay. So if you study the balance sheet of both JP Power and India Bulls Housing Finance, by the way, when I had made the video and took positions in JP Power, it gave 125% boost. That bet turned out to be really well, but opposite is happening in India Bulls Housing Finance. So let me very quickly do some commentary on it. So let me take you to the balance sheet of India Bulls Housing Finance again and take a look at borrowings. So the borrowings peaked somewhere in 2018, and after that the company has been sustainably reducing its borrowing. So it's not taking more and more debt. Now again, the same same exact thing played out in JP Power. That was the rationale of buying this stock, along with the viewpoint that the prices of these stocks were trading very low. It was unfortunate that the Ukraine-Russia crisis happened, some raids at India Bull Housing Finance happened, all that stuff. Therefore, the stock came down, but I deliberately said that, hey, these are swing trading recommendations, and these are also not widely made that, hey, just go and invest in a high debt company, because no pump and dump game was at least being played out. So I hope that you see this from that particular perspective. Investing in the stock market is a nuanced game. It's not as if that you should just go and invest all your money in one go. Again, you can go independently check both my JP Power video and India Bulls Housing Finance video. You will get more clarity on this issue. Now, will I be selling my India Bulls Housing Finance? So first and foremost, I only took like 10% of the position, and I had said on the video, I have not taken more. I'm not averaging as of now also. Why? Because there are some great stocks that are available at massive discount right now. So I'm putting my money in those great stocks. When the market conditions improve, we will track it and then we will take more positions in India Bulls Housing Finance if the need be. Am I selling my positions in India Bulls Housing Finance? The answer is no, I'm not doing it. Okay, so let's move on to third and final point, which is the pump and dump schemes. A few days ago, I had made a video on BCG, which is Brightcom Group. Now, if you take a look at the last 1 month performance of Brightcom Group, it has fallen by roughly 41%. And I explicitly said on my video that this looks like a pump and dump scheme. Can I prove it? No, I can't prove it. I can just study the financials fundamentally. And here is my video on Brightcom Group. You can go and watch it, where I've analyzed all the financials and fundamentals and told you that, you know what, something looks fishy in the company. And a lot of people started giving me heat that, you know what, this, that, great company, all that stuff. See, we don't need to take unnecessary risk. And even if you're taking some swing trades, it's completely fine. But majority of a retail investor's core portfolio should only be dedicated to good companies where you can digest the volatility. Otherwise, you will be forced to convert your notional loss into real loss. Should you be converting your notional loss into real loss in something like Brightcom and Paytm? If I were you, I would have done it. I'm not an investor in either of these companies. Again, not a stock buying or selling recommendation, but this is what I would have done given the current market dynamics. So in summary, retail investors should, number one, be comfortable with volatility. You should invest, not trade. Number three, please buy good stocks where you're okay seeing the volatility happen, because in the long term, markets are designed to come back up. I hope you enjoyed the video. Please press the like button and I will see you tomorrow.